Realty Income just reported second quarter 2026 earnings, and this one's a beat and miss story. After the market closed today, August 5th, the monthly Dividend company posted total revenue of $1.55 billion, up nearly 10% from $1.41 billion a year ago, crushing analyst estimates by almost $140 million. But net income available to common stockholders landed at $344 million, or 37 cents per share, missing the roughly 40-cent estimate, partly due to $54.2 million in impairments. Here's the twist. The number that actually matters most for a REIT, adjusted funds from operations, or AFFO, told a much stronger story. AFFO came in at $1.09 per share, up 3.8% year over year, in line with expectations. For a company built around steady monthly dividends, this was far from a bad quarter, just a story of strong fundamentals hidden behind one messy GAAP number. Realty Income kept deploying capital aggressively this quarter, investing approximately $2.6 billion globally, or about $2.1 billion on a pro rata basis, at a weighted average initial cash yield of 7.3%. But the headline story is a brand new growth channel, a $6 billion hyperscale data center joint venture with Cloud Capital. This move signals Realty Income is expanding well beyond its traditional single-tenant retail roots into industrial and digital infrastructure, tapping into the same AI and cloud computing boom driving so much of this market right now. The company's CFO, Jonathan Pong, noted that a lot of the capital markets execution risk has been taken off the table, with much better visibility into the deal pipeline. That's a meaningful shift for a REIT that's historically been viewed as slow and steady, not exactly a growth story. Despite the GAAP miss, management raised guidance across two key metrics. Full year 2026 AFFO per share guidance was lifted to a range of $4.44 to $4.45, up from $4.41 to $4.44. Even more notable, Realty Income raised its full-year investment volume guidance from $9.5 billion to $10 billion, with growth expected from continued net lease investments, industrial development partnerships, and that new data center joint venture. Portfolio quality backs all of this up. Occupancy came in at a rock-solid 98.8%, with credit losses running around just 40 basis points of rental revenue. And let's not forget what Realty Income is famous for. This is the company behind 670 consecutive monthly dividends and a member of the S&P 500 Dividend Aristocrats, having raised its dividend for more than 31 consecutive years. Before we wrap up, let me show you my own numbers. Full transparency. I've held Realty Income since August 18th, 2020. My current value sits at $3,168.97, built from $3,190.30 in total cash I've put in. On a pure price basis, my market gain is actually slightly negative, down $21.33. But when you factor in dividends, I've collected $386.10 in payouts, more than offsetting that price dip. That brings my total gain to $364.77, with a money-weighted return of plus 31.04% since I started. This is the perfect example of why Realty Income works the way it does. The share price barely moved, but the monthly dividend did all the heavy lifting. Not financial advice, just sharing my own numbers. So what's the takeaway heading into the rest of 2026? Realty Income delivered a quarter that looked messy on the surface, with a GAAP earnings miss, but strong underneath, with revenue growth, rising AFFO, high occupancy, and raised guidance. The Hyperscale Data Center joint venture is arguably the most important development, giving this traditionally retail-focused REIT a real foothold in the AI infrastructure boom. Going forward, watch how quickly that data center partnership scales and whether investment volume actually hits that new $10 billion target. For dividend-focused investors, the core story hasn't changed. 670 consecutive monthly dividends, over 31 years of consecutive increases, increases, and management that just raised guidance instead of lowering it. As always, this video is for informational purposes only and is not financial advice.